Hey, what's up guys? In this video, I'm going to try and value the stock of FSLY. Now, FSLY is a young, exciting company. They provide cloud computing solutions. So, one of the things they do is really help your website load faster. They really are infrastructure for the internet sort of thing. So anyhow, we're going to look at their growth, look at their valuation, use an intrinsic valuation model, and ultimately try and figure out what is the fair price for their stock. So let's jump into it. Alright guys, so here is FSLY's website. As you can see, a lot of big name companies do use their services. You got Shopify, New York Times, A&E, and some others. And as you can see, they have a huge network capacity there, 117 terabytes per second. Pretty impressive stuff. So here's FSLY's revenue by customer type. It's very interesting to note that about 88% of their customers are what they call enterprise customers. That means they're customers where they sold them at least $100,000 worth in the past year. Now, to me, that's very interesting. That means their customer base is a little more concentrated, a little more focused on just a few customers that are large, rather than being dispersed among many customers that are all small. Here's FSLY's revenue by region. They're fairly concentrated in the US with 68% of the revenue coming from there. But they also have 11% in Europe and 15% coming from Asia Pacific. Alright guys, so here is FSLY's stock. It has roughly quadrupled in the past year, going up close to 300%. It's currently trading at about $70 a share, giving it a market cap of about $8 billion. Now, the short interest is 22%. That is worth noting. 22% of their shares have been borrowed and sold short. That's a lot of haters, and that can really drag the price down. Now, if they outperform, you can see sort of a short squeeze action there. That could be very good for you as a shareholder, but it's also very dangerous indeed that you see such high short interest. I mean, who shorts the stock? Sophisticated institutional investors, hedge funds. These guys are not idiots, and if they're shorting it, that is a major concern. Here's FSLY's balance sheet. They have a very low degree of leverage there with a liabilities-to-assets ratio of just 13%, none of which is debt. The current ratio and quick ratio being the same because they don't have inventory. These ratios are both amazing here. 2.78, meaning their current assets can cover their current liabilities more than 2.5 times over. So really excellent looking balance sheet. Now, obviously they are losing money. They're a money losing company. You can see that from the negative interest coverage ratio. But their balance sheet's in very good condition right now. Now, they have a very limited operating history. But from the data we have, here it is. Here are their income statements. You can see they've taken revenue from about 105 million all the way to 291 million in a span of 4 years. Pretty good. Now, the gross profit has gone up as well, going from 56 to 171. That's nice to see as well. But they are losing more money than ever. You see their operating income is negative. Now, one thing I obviously do not like to see is they have kind of a proportional gain in expenses, to their revenues. So revenues have a little bit less than tripled, while operating expenses have pretty much done the same, going from 87 to 257. That's roughly times 3. So, I really don't like to see that with these young growth companies. that it can generate economies of scale, you tend to think a lot of their costs are fixed and that they're not going to be increasing nearly as much as the revenues increase. So, eventually they're going to be super profitable. Well, Fastly here is not off to a great start. And I'm not saying they can't finish well, but, obviously I don't like what I see at this point. If you're enjoying the content so far, please hit that like button, hit that subscribe button. It really helps support the channel. Now, Fastly's revenue growth going forward is expected to be quite impressive. In 2021, they're looking to earn about 31% more than the previous year. And then looking at 27% growth after that, down 24%. Now, every year after 2023 is based on the opinion of one analyst. So I'm not going to take that too seriously. We'll probably just plug in a steady growth rate of our own there. Alright guys, so at this point in the video, we're going to use an intrinsic valuation model to try and figure out what is Fastly stock worth. So I'll be using the free cash flow to equity model. I'm going to start with the analyst revenue growth estimates going forward. From those revenues, we're going to have to estimate profit margins. Now Fastly has been losing money, so those we don't expect that to continue. We have to figure that as they grow, they're going to be able to generate positive margins. That's going to be an estimation process. So let's jump into the spreadsheet and see how that works. Alright guys, so here's the path I see for Fastly. I've plugged in the revenue growth estimates going forward. After the next 3 years, kind of have to make up our own. I'll be fairly generous in my view. I'll assume about a 25% growth rate every year thereafter, up to the 10th year. After 10 years, we'll figure on some pretty low growth rate. So that gives us a stream of revenue. Now to get from revenue to net income, we need to know what the margins will be. Again, I am figuring on them steadily turning things around. That's also what a lot of the analyst reports that I've read estimate will happen. So we're going to figure on slowly increasing margins. We're at negative 33% right now, which is horrible. But let's say they can get it up to negative 16, then negative 4, and then turn positive there in year 3. And, eventually top out at about 29%. Now, if that's accurate, that gives me a stream of net income or profit. The last step is to subtract reinvestment needs. This company doesn't do hardly any CapEx, and they do acquisitions sporadically. So I'll estimate a fairly low reinvestment rate going forward, maybe a little bit heavier in the first few years here. The reinvestment rate is actually not really meaningful because they have a loss in those years. But anyway, afterwards it's going to be about a 15% reinvestment rate. So if that is true, that gives me a stream of free cash flows to equity. Let's see what the company is then worth. Alright guys, so I got those cash flows here. I have the terminal value. The terminal value is just that cash flow in the 11th year divided by our discount rate of 9% minus the perpetual growth rate. I'm going to go with 2.5% every year thereafter. Now, it may not exactly go like that. It may sort of die down slowly, but you have to simplify these things, put them into some kind of model here. And so if that is true, we come up with a total firm value of about $5.5 billion or about $48.40 per share. Now, unfortunately, that would mean the company is overvalued by 30%, which may explain all of that short selling going on. Now, do you want a lower return? Maybe I can change the discount rate here to, say, 7%. If you want a 7% return and these assumptions are accurate, the company is actually undervalued by about 12.7%. Here is insider trading activity for FSLY. A lot of insider buying in the past 3 months actually. Pretty comparable amount of selling. Let's look at the number of shares involved here. So when you actually look at the number of shares, it's actually a lot more buying than selling by insiders right now. That is very interesting because when you look at their stock price over the past 3 months, it's actually gone down 28%. So FSLY stock was as high as about 125 here back in October. It really tanked, and during the past 3-month period, insiders have been buying it up. So they believe it's undervalued. Very, very significant signal, guys. The insiders definitely know more about the company than we do. Alright guys, here are my final thoughts on FSLY. First of all, the balance sheet is in pristine condition. Very good balance sheet, so no risk there. But there is considerable risk in the operations. They are losing money. Let's face it, they're losing money every year. They have a plan to turn things around, but we really haven't seen it. We haven't seen the economies of scale take effect there. As their revenue has grown, their costs have also grown. So I really don't like to see that. Now look, with the intrinsic valuation, I've given them pretty generous estimates, I feel, to grow their margins and also grow their revenues. Even under those assumptions, it doesn't look like it's going to give you a very good return. A 9% discount rate, 9% return, you're not going to get it according to these calculations. Now, the trading data is very interesting. I see two opposing signals. Insiders are buying pretty heavily, actually. That is a good signal, very good signal. But the short selling is very high. So overall, it's a pretty risky situation, and you need to require a high return to get into it. So, for me, it feels like gambling at this point. I really can't say which way it's going to go. And so I'm going to stay out of the way, but that's just my thought. Let me know what you're going to do in the comments below. Thank you for watching.